Hello students, I am Dr. Shrikant Bause, Assistant Professor at Department of Advanced Management Studies, GS College of Commerce, Wardha. Today we are going to study one of the most important aspects of financial management, that is selection of asset mix. Each and every individual must learn how to select various assets for investment. This selection of asset will lead to build a great viable portfolio. This portfolio will help any individual to achieve their financial goals and financial freedom. If you are having a strong diversified portfolio, at that time you will literally enjoy a financial freedom in your life. Even in case of any contingency, it will not lead to any breakdown and your regular activities will not be hampered. So let's start how to select the asset mix. Firstly, we will decide and understand that what is selection of asset mix. It is the breakdown of all assets within portfolio. These assets may be stocks, bonds, cash, real estate and precious metals, to which we also called it as the gold or silver commodities. In the stocks, very large number of people used to invest, but very few of them are able to generate the wealth. So you should have a deep understanding of stock market before investing into any stock or share. In the bonds, we will be having different types of government bonds and private debentures. These bonds and debentures will yield us fixed income or the fluctuating interest. Here, there is a great difference between stocks and bonds. Stocks will give you growth, while bonds will give you interest. Next one is the cash. Each and every portfolio must have a certain amount of cash for the purpose of liquidity. You never know that when the need of cash will arise. For addressing any contingency or emergency, for fulfilling any requirements, immediately we should have a cash, liquid cash in our portfolio. Next one is the real estate. Right from the ancestors, people used to buy real estate for long term. It is very well said that the real estate is always real. It gives you the appreciation over the period of time. If you are buying a plot or land at a great place, it will appreciate like anything. So you should always have an exposure in real estate. For example, what we have seen in metro cities, the prices of real estate gets multiplied many times over a couple of years. Then next one is the precious metals, that is the commodities like gold and silver. In India, right from the ancient Hindu culture, people used to buy gold and silver. It is related with the religious things, with the auspicious occasions like Dhanteras, Dashera, Akshay Tritiya. People used to buy the precious metals like gold and silver. But besides its religious belief, these metals have rise like anything in the last 50 to 60 years. Even if you will look at the performance of gold in last 10 years, it has given 5x returns. So you must have precious metals in your portfolio like gold. Now the next thing is of percentage allocation, that how much amount you are allocating to stocks, bonds, cash, real estate and precious metals. Suppose if you want to decide how much should I invest in stocks, the simple formula is 100 minus your age. Suppose your age is 30 years. At that time 100 minus 30 means 70. You should invest 70% into stocks, remaining into bonds, cash, real estate and precious metals. Why so much exposure in stocks? It is because though they are risky, their earning potential is unlimited. We have seen the large cap stocks which are trading now in thousands of rupees used to trade at 10 or 20 rupees 10 years back or 20 years back. So this is the earning potential of stocks. In bonds you will get a fixed income, cash for the emergency, real estate for long term appreciation and precious metals for long term gains. Then risk reward balancing. Suppose you are investing completely into stocks and an epidemic like COVID-19 attacks the economy, your complete portfolio will become half. So in order to avoid such conditions, you should have some exposure in bonds, cash, real estate and precious metals. So this is the significance of percentage allocation. Your risk will be diversified. Next, long-term expectations. When you are building a portfolio, you have to keep in your mind your long-term expectations, that how much returns you are expecting after say 10 years or 15 years or 20 years or 25 or 30 years, because it takes time to reap the fruit. If you are sowing a seed today, it will take time to make it big and flourish and yield a fruit. So your long-term expectations also matter. If your expectations are pretty high, you should have great exposure in stocks and precious metals and real estate. If your expectations are pretty low, you should go with the conservative approach. Next, growth versus fixed income. These stocks will give you growth, real estate will give you growth, precious metals will give you growth, but bonds and cash will give you a fixed income. By investing into FDs, if you invest cash into fixed deposits, you will earn interest over it, and that will be fixed income. If you are investing into bonds and debentures, you are entitled for the interest. Next one is asset mix of equity fund. When you are investing into equity fund, that equity fund may be large cap fund or mid cap fund or the small cap fund. Large cap fund invest into large cap companies whose market capitalization is more than 25,000 crores, mid-cap companies whose market capitalization is less than 5,000 crores but greater than 1,000 crores, and small cap companies whose market capitalization is less than 1,000 crores. Here in the small cap the risk is highest, but as we say, high risk high return. Small cap will give you higher returns. Mid cap risk is quite high but also give you great returns. In large cap risk is quite low because even if they goes down, they are having an ability to bounce back. So this should be the exposure. You should use the optimum exposure in large cap, then mid cap, and then small cap. Then the next point is of domestic investment and international investment. Suppose you are rich and affluent, you are wealthy, you can opt for domestic investment as well as international investment. This also diversifies the risk. Next one is the balanced fund, where there will be balanced, that is, say for example 50% in equity and 50% in debt. Then the point of liquidity. If you are investing into real estate, if you are investing any commercial property, at that time when you want to sell property, it is not possible for you to liquidate it immediately. It will take time. You will have to find a buyer. You will have to approach the broker. Suppose you are anticipating that you will get your property sold at 1 crore rupees. It's also possible that the buyer will ask you for selling that same property at 70 lakhs only as per your need and emergency. So liquidity is a concern in real estate, but in stocks, bonds and cash, the liquidity will be highest. Your risk appetite, high risk, medium risk and low risk. If your risk appetite is high, at that time go with the stocks. If it is medium, have a combination of all these. If it is low, you should be in cash and bonds only. Then the duration, whether your approach is short term approach or the medium term approach or the long term approach. If your approach is of short term and medium term, you should go for cash and precious metals. Only if your approach is long term, go into the stocks and real estate. Then the past performance and historic returns. It is a very bad habit of people that they used to see the past performance and historic returns, because it is very clearly mentioned that the past performance may not repeat in the future, may or may not, because the market will be different at every point of time. So past performance and historic returns will give you some guide, but there is no assurity that you will get the same. So you have to make informed decision. Then how to take all these things? You should approach a financial analyst. When your health is not good, at that time you consult with an expert doctor. In the same way, when you want to have a good financial health, you should approach to the financial analyst. Self-medication is always dangerous. One should not rely on any self-medication or broker for their financial well-being. They should go to the financial analyst, they can avail their services. Then the fund managers. Suppose you are not having experience of stock market or bonds market, you should go with this kind of funds, mutual funds, and these mutual funds will be managed by the expert fund managers, which are having immense knowledge and experience. Next one is the self-study plus discipline. There are many people who are extremely passionate about the stock markets. They used to do self-study. They used to watch the market on a regular basis, but after self-study they should have some experience. They should start very slowly and must have a disciplined approach for getting a strong returns with the help of diversified portfolio. So this is all about the selection of asset mix, where you have to diversify your investment in stocks, bonds, cash, real estate and precious metals. Thank you.